Hi, this is Mike Mock. It's Tuesday morning, November 15th. We've got the morning comments here for you, courtesy of Lansing Trade Group. Markets yesterday, want to take a quick look back. We had a continuation of some of these trends that we've seen since the election last week in the sense that the U.S. dollar very, very strong. We traded above the 100-point level first time in a while. We're at the upper end of this range that we've really been in since 2014, and obviously that's when the commodity markets really took a tumble. Everything from grains to energies. But we did see a bit of a turn in that trend yesterday after starting out poorly. By the end of the day, the crude oil market had actually turned a bit, and overnight crude oil firmer and the grains perhaps a bit more stable. But the strength of the U.S. dollar is expected to continue. The U.S. interest rates are continue to expect to grind higher, and those two things set up a bad situation, a bad background for the grain space. And we're concerned about that. I talked to a number of folks yesterday in the business, bankers, crop insurance agents, and the folks, just to try to get kind of the lay of the land, and they all indicated a general theme, and one is that the farmer had really superlative bean crops and was very comfortable selling beans off the combine. Even the excess over contracts were sold cash over the scale type of a scenario. So that generated a lot of cash flow and has bought the farmer some time. But the concern is that there's a lot of unpriced corn in the bin at home, and we're afraid that as we get closer to the Thanksgiving holiday and folks are wrapping up their harvest, that they tend to forget about their responsibility to market the grain moving forward. And what ends up happening is that the farmer sells when he has to rather than he chooses to. In other words, cash flow begins to dominate the discussion. So one of the things that we want to do is make sure that we're generating conversations, a lot of discussions back and forth with the LTG merchandising staff and the growers out in the community to make sure that we're taking a peek at what the opportunities that are presented today. If we know that we've got a tax bill coming in February, landlord needs to be paid in March, we want to address those issues now. There's good carries offered in the marketplace. We really like the opportunity to sell out into the spring and summer months. That's where the best money is. And what farmers will often say is, well, I can't afford to keep the grain that long. I'll need cash flow. So one of the things, this is very old school, but we used to do this on a regular basis, is that go to your local FSA office and take a look at the opportunity to take out a loan from the government. They'll come out and measure your bin. You'll get access to dollars that way at a very low interest rate, somewhere in the neighborhood of 1.5%. Then you can use those dollars to pay off your operating loan, which may be 3 points higher at, say, 4.5%. That will flow you until you can get out to when those grain deliveries will be made later in the spring and summer. So again, take advantage of the carries that are offered in corn. Your fellow farmers aren't looking that far forward. We want you to stay out there focused, line that up your cash flow needs out forward, and then to bridge the gap, take a good hard look at the very old school method of taking out a government 9-month loan. That'll get you through until you move the physical grain later in the year. That's all I got for you now. You have a great Tuesday. We'll see you first thing in the morning.